and welcome to Property Question Time with me, Bryony Bilson. This is the show where you get the chance to have your questions answered by our resident property experts. So, let's see who we have in the hot seat today. First of all, a warm welcome to Paul Mahoney, the founder of Nova Financial Limited. We also have Tony Gimple, founding director of Less Tax for Landlords. And last but by no means least, James Jenkins from Money Sprite. Welcome. Today we're going to be looking at quite a wide range of subjects, and thank you to those of you that have sent in your questions. We'll be looking at everything from how to overcome mortgage serviceability issues to running a professional property portfolio. And we're going to start things off by going to one of our first experts, Paul Mahoney. So Paul, are buy-to-let mortgages based on a fixed percentage of the value of the property that would be let out, or on the affordability of the applicant to make the repayments?
Well, the answer is both. Lenders have two main criteria, the loan to value being the amount of the loan versus the value of the property, and serviceability, which when it comes to buy-to-let mortgages is generally based upon the rent generated from the property in servicing the mortgage repayments or the interest on the mortgage. And they'll generally lend you the lower of the two amounts. So the average maximum, if you like, for buy-to-let mortgages is 75%. Some lenders will lend more, some will lend less. However, as an example, if you've got a £100,000 property, most lenders will lend you 75% of that being £75,000. The other requirement is that you are able to service that loan. So the Bank of England recently introduced a benchmark rate for buy-to-let lenders, which was 5.5%, and that needs to be covered 125% of the time to account for any vacancy periods. So there's a calculation beyond there which I won't go into right now, but that essentially determines how much you can borrow on that side of things. And they will lend you the lesser of those two amounts. If you fill both, then you can borrow the maximum. If you don't, then it's the lower amount.
Thank you. I know it's quite a confusing area, and you really summarised that in a very clear way, so thank you. I'm sure that will really help our viewer. So Tony.
Paul described very well the mortgage affordability rules that are now coming in. But there's maybe another agenda to that, in that one of the largest networks has asked its mortgage brokers to check with their buy-to-let clients whether or not they've taken tax advice. And that's probably as a direct result of the introduction of the Section 24 changes, the removal of mortgage interest costs as an allowable expense. What impact that finally has, either from a compliance perspective or whether or not lenders may use that as part of the mortgage affordability criteria, we don't yet know. But it's no longer as easy just to rock up at the building society and say, lend me some money please. Now there's much more diligence being done to prevent a further meltdown.
So it sounds like you really have to put your research in on this area and ask a lot of questions. It's not as straightforward as it used to be.
Correct.
This is an area to be careful with. Thank you. A difficult area, but summarised really well there. So thank you for that, Tony and Paul. My next question is actually to you, Tony. And it's from one of our viewers. They say, I have a fairly substantial life insurance policy, but want to ensure that the payout goes to my children, not into my estate. Is it right that I can nominate it to go into a trust and have it separated from the rest of my estate?
The short answer is yes, and this is one of the few occasions where it's absolutely appropriate to use what would be called a discretionary trust. The two main benefits are by placing a life insurance policy in trust is one, it will pay out before probate is granted. A trust is what's known as an artificial personality, and it hasn't died. And therefore you can take the money out during its lifetime. And secondly, the money will be paid free of inheritance tax. Now there are some limits to that. And if you have policies which are worth more than £325,000, you should speak with your financial advisor in terms of possibly segmenting those policies and having a separate trust deed for each one. Either way, your financial advisor should be able to put the policies in trust for you, either from outset or with the provider later. But if that's not the case, make sure you seek appropriate advice.
Thank you. And is this advice mostly addressed towards people with very large estates? We're talking farms and land, or is it applicable to people with smaller property portfolios?
It's pretty universal, whether
Okay.
you're a property owner or you're a farmer, and there are special rules for farmers, but that's a whole topic in itself. Generally speaking, if you buy life insurance of whatever flavour, in trust is the best solution.
Thank you. And James, do you have any advice on this area of trust? And
Well, Tony's absolutely covered it, I would suggest, but the key point I think to take out from a buyer's perspective is putting it into trust is incredibly easy and straightforward to do. It's not something that you would need to panic about or worry about. Any financial advisor who's arranging life insurance can arrange that trust at the point of application, and it's a very quick process as long as you know who you want it to go to and who's going to be on your trustees. So very straightforward process to do. Don't be afraid of it.
brilliant. I think that's really great advice. A lot of people, I think, often do worry about, you think, well, trust, that's a confusing or a difficult area to go into, but you're actually saying it's very straightforward, the advice is there, and the people are ready to help.
Absolutely, 100%.
In certain circumstances. Trust, I've got a bit of a health warning. Trusts ain't what they used to be.
Okay.
For things like life insurance, yeah, really, really simple. If you're thinking about putting a property in trust, yeah, be very, very careful. It's a much more complex subject.
So tell me a little bit more about trustees. How do you select those, and what advice would you have in that field?
Normally there are three parties to the trust. The settlor, that's the person who's putting the money, the life insurance policy, into this trust deed. The trustee, the person you trust to administer the terms and conditions, and the beneficiary, who may either get an income or capital. Who should you appoint as your trustee? Somebody you trust? Effectively, it's like giving them your bank card and PIN number. You've given them £500,000 to look after until your child is 21 or 25, say. So that's a bit of responsibility. So choose wisely. You won't need a professional to do it. They'll only charge you an arm and a leg. Husband, wife, adult child, brother, sister, mother, father. If they need help, they can always go and buy that help for the little bit they need.
Excellent.
I would also add to that as well that it's not always about putting it in trust for a child. Yeah, if a couple are buying a property jointly and they have separate life policies, they can each put those life policies into trust for one another to avoid, as you say, potentially avoid inheritance tax.
Especially if they're not married.
Especially if they're not married. And in those circumstances, the trustee can also be the beneficiary. So it doesn't even have to be as complicated as going out and finding three different people. It can be one and the same in those circumstances.
Brilliant, thank you. That's really helpful advice, and I think potentially for a lot of our viewers that might be in that situation, perhaps buying together, they're not married and would be looking to make those decisions. So thank you for clarifying that. Excellent. Right, on to our next question, and it is to you, James. My wife and I want to add our son to the mortgage as a co-owner so that when we die, he automatically becomes the owner, having contributed to the mortgage payments. Can we add a third party to our joint mortgage?
Okay, there's a couple of parts to this question. There's potential tax implications, which I'll pass over to Tony in a second on that, if that's okay.
Of course.
The short answer is yes, you can. Now, it does depend on the lender who you have on the property at the moment. So some lenders will allow three people on mortgage, some lenders won't. So it just depends on who you're with at the moment as a mortgage lender. You would apply to that mortgage lender to add that person on and therefore add them to the deeds as part of doing that. So they would need to go on the mortgage to be on the deeds. Now, if your existing lender won't do that and won't allow three people on the mortgage, there are plenty of other lenders out there, mainstream lenders, who will allow 3-4 people onto a mortgage and therefore the deeds. A couple of points to look at is firstly how you register the property, whether you register it as tenants in common or joint tenants. And I think Tony can talk a bit about the implications of that. And there may also be stamp duty implications for adding somebody onto the mortgage because they're taking some of the value of the property. I don't know if you wanted to add a bit on those two bits.
Yeah, let's start with the stamp duty. If you're adding, assuming you can add a third party to the mortgage, they pass all the mortgageability criteria. I believe if the amount they're borrowing is above the stamp duty limit, then there could well be a charge to SDLT. So you have to be careful with that. The joint tenants in common part is really very important. Basically, there are two ways people can own property: joint tenants and tenancy in common. As joint tenants, the law says there's only, no matter if there's 4 on the deeds, it's still one person. You each own the same 100%. What's mine is mine, and what's yours is mine, effectively. And upon death, the property passes to the other joint tenants. But that can be quite complex. It can cause all sorts of problems, potential inheritance tax issues, if it's investment property and so on. As tenants in common, however, there can be up to 4 legal personalities, each owning a share, equal or otherwise, and it gives a lot more flexibility in how I dispose of my property share. I may not want it to go back to James, but I want it to go to Paul instead. And that would allow me to do that. However, you will need wills that cover the issue as to who gets what, and very importantly, because now all 4 signatures are required to do anything with the mortgage or the property, each party will need a lasting power of attorney for their property and financial affairs, so that they've nominated somebody to speak and act on their behalf if they can't. Who should that be? Pretty much the same as the trustee, just somebody you trust who can act in your best interests.
Thank you. Brilliant advice on that one, and I think our viewer will definitely find that information useful. Paul, do you have anything else to add in this area?
Yeah, just a couple of practical points to consider when it comes to adding other people to property ownership. It's quite important to make sure that the timelines and the goals of each of the people are quite closely aligned. And I'd say generally with a son or a daughter, for example, although with their family, their timelines are very different to yours. And certain financial decisions for them might be different to yours as well. So making sure that that's all aligned, or there's at least an agreement, you know that that's not going to fall out of bed. Other things to consider is something that I've found people don't realise is that by going onto a mortgage, you aren't just liable for your portion of that mortgage. You're jointly and severally liable, meaning you're liable for the whole mortgage.
Right.
So, for example, if that son or daughter may not be actually living there, and then they want to go and get their own home or their own buy-to-let, well, lenders will look at them as being liable for the whole mortgage. So that could affect their ability to get mortgages elsewhere. So that's important to do.
So it's definitely very important to have family discussions, where you're at now, where you all hope for things to be, and what goals you might have for the future as a whole family, so that everyone's outcomes are considered.
Yeah.
Excellent, thank you. That's all we've got time for now, but please join us after the break. Hello and welcome back to Property Question Time with me, Bryony Bilson, and with our expert panellists today, we have Paul Mahoney, Tony Gimple, and James Jenkins. Welcome back. So Paul, we're going to go straight to you with your golden nugget.
So I mentioned earlier about some changes with regards to mortgage serviceability, and that's getting a lot of people concerned around whether they're actually going to be able to borrow as much as they owe, especially in areas like London, the southeast, where the yields are lower than other areas. And when you apply the usual calculations, in a lot of cases you wouldn't be able to, or not necessarily that, but also you wouldn't be able to sort of keep remortgaging and keep investing as you have been able to in the past. One way of overcoming that is by going for 5-year fixed rate products, which essentially circumvent the change. It means that lenders are able to use the actual product rate for the benchmark rate, and therefore enabling you to borrow more. So I suppose one reason to seek advice when it comes to getting mortgages, I know some people don't like paying fees and things, but often the fee is a very small amount in compared to what you can save and the value that it can add. So at the very least, speaking with an advisor on what you can do and how you can best structure your finance to help you sort of build and achieve the goals you're working toward.
Brilliant advice. So really don't be frightened to invest in getting that professional advice, particularly in this area where it can be quite complicated.
Exactly right, yeah.
Excellent, thank you. Does either of you have anything you wanted to add on that?
Yeah, I mean, I know exactly what Paul's getting at, and it's the buy-to-let market, particularly with their existing clients, where they've bought buy-to-let properties 12 months ago or 2 years ago and are now looking to remortgage, and actually the calculations we now have to use to work out whether they can even remortgage just the debt they currently have quite often precludes them from changing their mortgage. Now, some lenders are looking at, or have implemented, changes whereby if it's a pound for pound remortgage, they'll waive that calculation. 5-year fixed rates is another way to reduce the calculation that lenders need to use, or we need to use to work out whether they can borrow and what they can borrow. What is important, and Paul's point is exactly right, is sit down with an advisor. The problem is sometimes a 5-year fixed rate doesn't meet with your goals. So getting a product just to be able to borrow money isn't necessarily the right way to look at it, but do sit with a financial advisor, look at what your goals are with that property. If you're looking at having it for just a couple of years and selling it, you've got to bear in mind things like early repayment charges that may, again, cost you more money to get out of that deal again later on. So look at what your goals are, talk to a professional advisor, and then there may well be a solution, and there more likely will be.
Brilliant, thank you to all of you. Fantastic advice there again, really valuable insight on steps forward with that, getting a bit of perspective and goal setting before perhaps going forward with those decisions. So thank you to that. Right, well, we're going to have another golden nugget, and I'm going to ask you, Tony, what advice do you have for our audience today?
Almost a difficult thing giving advice, but run your portfolio as a business. It's no different from a corner shop, TV studios, accountancy, law, financial advice. It's a business. It only exists to make a profit. And it's the profit that will allow you to achieve your goals. So treat it seriously. You know? Apply all the things that you would otherwise do in running any other business. Do I employ people? Am I looking to minimise my costs? Is tax going to be an issue? One thing you need to be very careful of, however, is just because it's a business doesn't mean to say you should run a property portfolio, a buy-to-let one, as a limited company. That will be very expensive for you.
Okay. Tony, why do you think it is, particularly with property? A lot of people often seem to get very emotionally involved with property, and perhaps maybe that clouds them making the right professional business decisions. Do you have any experience or opinions on that?
Yeah, I mean, look, an Englishman's home is his castle. You know, property is easy to understand. When you buy a house, you tend to buy it with your heart, not your head. When it comes to buy-to-let or development, it's got to be head and not heart. It's not what it is. Forget it's a house, it's just another raw material. How am I going to make a turn on this piece of raw material? It's a commodity. And so you have to remove the me, if you like, from the equation and look at it wholly objectively. If I buy it, what am I going to get? What yield? As you say, and yield income is good. And you've got more control over income than you have over capital growth. But what, if it is about capital growth, what will the return be in 1, 3 and 5 years? Whether I like it aesthetically, actually it makes no difference whatsoever. It just does it stack up.
Yeah, so keep a clear head, keep working with the figures, keep that business professionalism in mind, and you can't go too wrong.
One would hope.
Fingers crossed. Excellent advice, Tony. Thank you for that. So time for another question. James, this viewer says, there used to be set amounts that you could get a mortgage for as a multiple of your income. I think it was 3.5 times the first applicant's income plus 1 times the second applicant's income. Is that still the case now?
Yes, it is, I guess is the answer. There is still an income multiple that underwrites pretty much every bit of lending in the mortgage industry. Days were certainly much easier when that was just the calculation. If someone sat in front of you, you could work the mortgage out very, very quickly. Nowadays, it's very much underwritten on affordability. So every lender has their own affordability model and own affordability calculator. So they work out what they think you can afford. But underpinning that is an income multiple still. So they may say you can afford to borrow X, but that X cannot be more than 4 times your joint income. In terms of the question on what the income multiples are, lenders will lend anything from 3 times joint income up to 5 times joint income. So the sort of 3 plus 1 has gone. It's all about just the one multiple. It's 3 times income, 4 times income, 5 times income. But it's the calculator that decides whether they can actually borrow it as long as you don't exceed that income multiple.
Brilliant, thank you. And also, am I right in thinking you used to be able to get a mortgage for up to, say, 25 years? Has that changed now?
It's certainly changed depending on where you are in your life cycle. Mortgage lenders, there are lenders that go up to 40-year term on the mortgage. More commonly, 35 is the maximum that lenders will go to. We would always look to advise clients to take the mortgage for a shorter term as you can possibly afford or comfortably afford. But yeah, that term can be anything, a multiple of 1 year from 5 years right up to 40, depending on the lender.
Brilliant, thank you. Thank you, James. Excellent response to that question there. Paul, given the choice of buying a £300,000 property in England against a much larger €300,000 property in Europe, what should I consider if I didn't intend on using either of them myself? Making sure the value of my investment is not going to drop is my absolute priority.
Okay, it's a fairly common question. I personally am a big believer in buying property in your home country. And I'd say the main reason for that is currency risk. In that you could buy that same property in either country and both could go up in value, but if the currency or the foreign exchange moves against you, well, that gain can be wiped out. Of course, that can move the other way, but it's very difficult to predict. That's the first point. But I'd say the determining factors would not necessarily be that. It would be about the fundamentals. You know, the supply, the demand in the area, the socioeconomic levels, what the demand for certain types of properties are. You know, is this the right type of property for that area? What's changing in the area? You know, I'm constantly saying that property doesn't increase in value because it doesn't. You know, there needs to be a reason for it. And the main reasons for it are generally infrastructure spending, employment growth, population growth, something that's going to create positive change. All the key fundamentals that go into selecting any property investment should be applied to any location. So I'd say that would be the main determining factor in deciding where to invest, but taking it away from the property, because we tend to focus more on the person themselves, probably more importantly is what is that person trying to achieve? You know, are they looking to build an asset base and therefore is growth most important to them? Do they already have the asset base and therefore is income most important to them? You know, what are their goals? What's their plan? And then which, you know, I suppose use that to set the criteria for which makes the most sense for them.
Excellent, thank you. Do either of you have any experience of property overseas versus the UK, or would you agree with Paul, invest at home if possible?
I would agree with Paul, if I'm honest with you. I think from a more simplistic point of view, I think if it's your first investment and you're inexperienced, you're far better to have something you can see, feel, touch and go and look at, rather than something the other side of Europe that it's that more difficult to keep an eye on as a property, as an investment. So that would be the way I would view it.
Alternatively, if you just want to buy a house in the sun, a home in the sun, then it's your home in the sun. It's not an investment. You're buying it just for yourself. So whether it makes money or not actually is immaterial. It's somewhere you can go to once, twice, thrice a year and just sit there on the beach and enjoy.
And I think we've touched on this before, haven't we, Tony, about the difference between, is this a business, professional business plan that you're looking to extend and build on, or is this perhaps something that's got more of an emotional element? It's, like you say, a second home. You want to enjoy being in the sun, in which case your thinking and your thoughts behind that are going to come from a very different perspective.
And hopefully the business will fund the home in the sun.
And I'd say that's very relevant to that question, because I think a lot of people like the idea of having a home in Spain or Portugal. And if that's the reason, then you just shouldn't do it, unless that is the reason. You know? If you're not going to live there and it's about investing, then put it out of your mind, because it's not about what you want.
Brilliant, thank you. Good advice for our listeners there. Thank you, gentlemen. Tony, I've heard of something called capital allowances, which I think is the ability to offset all expenditure on a rented out property's fixtures and fittings against tax, even if it's expenditure from previous years. Is that right, or have I got the wrong end of the stick?
You are right, and no, you haven't got the wrong end of the stick. Yeah? But as all of these things, it's not quite as it seems. Basically, if you own a rented property, not a single tenanted unit, then capital allowances are available to you as the property owner, the landlord. There are some basic rules. If you purchase the property prior to 2014, there's no time limit to making a claim for capital allowances, providing the previous owner hasn't claimed them. So that will have to be checked. Well, somebody who knows where they're at. But if you purchase the property after 2014, you have 2 years to begin the claim. What would a capital allowance be worth? Well, in some circumstances, it can be worth up to 40% of the purchase price.
Wow.
And capital allowances effectively is unclaimed money. It doesn't belong to anybody. It's just swishing around in the system. And you're perfectly entitled as the landlord, property owner, to put in a claim for it. But with all these things, don't do it yourself. Make sure you speak to the right firm who understands how to do it properly.
Brilliant, yeah. So get the right advice and have a bit of confidence, because our viewer here obviously had understood correctly.
Had understood it properly,
and I think sometimes perhaps in these areas it is having a bit of confidence, isn't it, to absolutely seek the right advice, but in this case they have understood. Fantastic. So last but by no means least, James, do you have a golden nugget for our audience?
Yeah, just a quick one really on adverse credit, if I can. We see an awful lot of people now whereby they either believe they have horrendous adverse credit and they won't be able to get a mortgage, or they have no idea that what they've got actually would be termed as adverse credit. So what we'll talk about just very briefly is a good idea for all buyers before they start looking at mortgages is to maybe register with one of the credit reference agencies and get a copy of your credit file, so you can take that along to the appointment, so the advisor you speak to can have a good look at what your profile is day one. Basically back before 2008, pretty much we had things called pulse mortgages. So basically, as long as you had a pulse, you could pretty much borrow from a mortgage lender. That's not the case these days. But what people now, lenders are looking more and more to open up the adverse credit lending market. So people who maybe do have debt management plans, defaults, county court judgments. There is possibly mortgages out there for you now, whereas maybe 5 years ago those weren't in place at all. Things that are really harmful now to mortgages are actually things like payday loans. If you have a payday loan within the last 12 months, mortgage lenders pretty much across the world are going to turn you away. So do be cautious, do know what's on your credit file. I think that's really, really important. But also very minimum levels of adverse credit, things, a missed payment on a mobile phone, a late payment on a credit card. They don't necessarily mean you're going to have to go straight down the adverse credit lending route. Certain high street lenders will make allowances for very small offences, should we say. So the key point is get that credit file, take it along to your appointment with you so your advisor knows what he's looking at, what he's dealing with, and to make sure he gets the right mortgage for you.
Brilliant, excellent advice. So really cards on the table, be very clear, be very open about your past experiences, and then they can advise you in the best way possible.
You'll get to the answer a lot quicker and you'll get the best answer because of it.
Brilliant. Thank you. Thank you so much, James. Well, unfortunately, that's all we've got time for, gentlemen. Thank you so much for your fantastic answers and for giving up your time today. I know you are all extremely busy and need to get back to your businesses. And thank you to you for joining us and for sending in your fantastic questions. If you'd like to get involved, please email us at info@property-tv.co.uk, or why not download our app where you can ask questions and find all sorts of information and advice. Thanks for watching, and we'll see you next time.